I think QE3 would require the economy to deteriorate somewhat from where it is right now. The basic story on the U.S. economy is that we've had good news over the last 6 months or so, especially compared to the recession scenario that was being painted in the August-September time period of last year. Since then, we didn't get the recession, and instead we got stronger economic data, including good jobs reports and declining unemployment.
St. Louis Fed President James Bullard there telling us what he believes it would take for the US Central Bank to unleash QE3 onto the economy. His comments come just hours after Fed Chief Ben Bernanke pretty much did away with speculation the Fed could backtrack on its pledge to keep rates near zero till 2014. Bernanke said low rates were necessary to support the American labour market. But as Bullard said, the world's #1 economy has been faring pretty well recently, with data pointing to a turnaround. He went on to tell us that he believes the risk of higher inflation is the biggest challenge to the global economy right now, but he didn't talk about the bugbear that's creeped up on radars, the risk of a hard landing in China. Recent data out of that country has fueled fears the mainland is headed for a deeper slowdown than forecast. According to traders, that sparked a wave of yuan selling and capital outflows, which has led the People's Bank of China to set the yuan midpoint at a record against the dollar for a third day running. Joining us now to talk about this from Hong Kong is Johanna Chua, Chief Economist for Asia Pacific at Citi, chatting to Adam and me. Johanna, great to have you with us today. I noticed from your latest report that you're essentially saying that this really positive sentiment that we're coming out of the US on the back of stronger data is overdone. That together with the comments that we've seen recently, and I guess, of course, the sentiment surrounding China growth.
Look, I think China accounts for about, a third of global GDP growth. So clearly, if you're very pessimistic about China, you can't be overly optimistic about the U.S. Clearly, there are some sort of linkages as well there. And I do think, I definitely do not subscribe to China hard landing view. I do think some of the pessimism in China is a bit overdone because it assumes that there's no policy response. And we do expect there will be some policy response forthcoming. But having said that, on the U.S. side, I mean, we've upgraded our growth forecast, but I wouldn't say we've massively upgraded our growth forecast. We're still only talking about 2% growth in the U.S. at this point.
So do you think then that the comments that we had overnight from Ben Bernanke are correct? I mean, do you essentially agree with his comments there? It does seem like rates are going to remain low for longer.
Well, I think, obviously that's very favorable for risk assets. The fact that he continues to support that view underlies his view that U.S. economy is not exactly that strong as some people might believe, that there are still some structural hurdles and issues there, and that's why they need to keep rates relatively low. So obviously, I think that's pretty positive for risk assets in Asia. When we wrote our report, we were a little bit worried about, sustained backup in U.S. yields. So we're having a bit of a reprieve. But I think, medium long term, I think, a lot of our strategists and economists still see U.S. yields will head up higher, but we don't expect the Fed to normalize interest rates anytime soon.
Johanna, is that what you attribute to the reaction in the bond market we saw yesterday with the 10-year yield creeping a little bit higher?
Well, I think, obviously the yields moving higher is a reflection of optimism about U.S. growth. And I think to a certain extent, because it's not like U.S. economy is extremely healthy to begin with, I think Bernanke kind of talking down rates is trying to sort of temper those expectations. Obviously, U.S. cannot sustain a very sharp rise in U.S. rates as well in this environment.
Well, okay, so if bets are being made in the bond market, we're going to have relatively healthy U.S. growth and yields continue to rise in the U.S. What's that going to do for debt markets out here in Asia then, and the currencies?
Well, I think I think it makes things complicated for Asia because at the moment, with the exception of a few countries, maybe India with a few more rate cuts, China with triple R cuts, most central banks in Asia have pretty much are done with cutting. And if anything, actually the tone of central banks have actually shifted to a little bit more hawkish tone from a previously neutral to dovish tone. So I think if anything, while rates are going to stay low for now, if anything, it's more likely that the next policy move could be a normalization of rates up rather than a cut. So that obviously complicates the outlook for how much more bond yields can rally in this environment.
Okay, I know you're not a speculator or betting woman, but if you were to bet, who would be the first to pull the trigger then? Would it be Indonesia? Because a lot of people don't really like the rupiah or Indonesian bonds at this juncture.
You mean to pull the trigger on rate hike or, I mean, on foreign
interest
flows?
Rates, sorry, interest rates.
Right. I mean, look, I think at the central banks, I think candidates that could potentially normalize rates earlier because of inflation concerns. Indonesia is certainly a candidate, given that today or this week we should find out Parliament is going to be approving, hopefully, the fuel price hike. So that's something that we need to watch out for. So Indonesia is a candidate for earlier normalization. You know, I wouldn't put past that Singapore potentially, while we don't expect any move in April, it's possible in October if economy continues to do okay and core inflation is sticky. Other candidates are, you know, Korea, Malaysia. Those are potential candidates for earlier normalization by the latter part of this year, although at the moment we haven't factored it into our forecast yet.
You know, we spoke to a policymaker in Indonesia a little bit earlier on in the program, Johanna, who said to us that these changes to the fuel subsidies aren't going to really have an impact on inflation, very much focused on the account deficit. Bank Indonesia, though, has previously predicted that inflation will rise to more than 7% even, from its previous forecast of 5.3% if the government does in fact go ahead with the plan. This plan does look like it is going to go ahead. That is a general consensus in the market. Are you concerned about what that will do to inflation in Indonesia?
Yes, I mean, it's something that we need to watch out for. I mean, clearly, economy continues to do quite well. If you look at consumer survey for price expectation in Indonesia, they're quite elevated. So the tricky thing is how to manage the fuel price hike so that you temper the second-order demand-driven inflation pressures going forward. So, you know, at the moment, core inflation is still manageable, but I guess, you know, if you look at past episodes of fuel price hikes in Indonesia, it has had second-round effects on inflationary spiral, and that's something we need to temper in an environment where, you know, central bank in Indonesia has kept rates quite accommodative and have been cutting up until recently. So obviously the tricky thing is how they're going to be able to manage expectations. And I think there is a risk there of sort of earlier normalization than earlier anticipated if inflation does go up. And you know, we do expect definitely inflation by the end of the year will go up above 7%.
Okay, Johanna, with oil in mind, which of the economies out here in Asia that are in the sweet spot because with oil at elevated prices?
Look, I think the only country that really benefits from a positive terms of trade shock is a standout is Malaysia, right? Malaysia is the only one, sort of the big, large net oil commodity energy exporter. The country that I think is quite vulnerable on the flip side will actually be India. Because, you know, unlike other countries, I mean, Korea and Thailand are also net oil importers, but India has a bit more policy inflexibility because you have inflation that's still quite high, you've got a potential pass-through there, you've got fuel implications on the subsidies on the budget, which is also negative, and you've got a current account deficit and reserve coverage, which is not as comfortable. So the impact of a negative terms of trade shock on the external liquidity is also going to hit India. So India, I think, is definitely vulnerable on oil shocks. At the moment, we are expecting that RBI will still cut a few more times this year. But, you know, again, if oil prices go up quite sharply, that window and opportunity will disappear.
Okay. All right, Johanna, we're out of time. Great to have you with us. Thanks for chatting to us here on Cash Flow.
Thank you.